everyone, and thank you for tuning into this update. I'm Joshua Dobi. Appreciate you much your willingness to spend a few moments with us here as we're looking at things that are happening to us economically and financially right now. But before I get into that, first and foremost, I'm going to start this way and I'll end this way also. Happy Thanksgiving to you. I hope that this finds you well and that you're able to spend some time with family, friends, and loved ones to enjoy this special time of the year. So please receive warm Thanksgiving wishes from us here. I want to touch on just a couple of items, and because it is the holiday, I don't want to take too much of your time. But I want to touch on just a couple of items as our updates are more frequent during this time, especially with the market pullbacks that we've had here in 2022. And to provide a few points for consideration and things that we're seeing, we've talked a lot about inflation, interest rates, how both have increased dramatically, and how the Federal Reserve is using interest rate increases in order to dampen demand or dampen inflation. We're starting to see that. You heard me say in one of our most recent updates that we've started to see a slight downtick in inflation. Now, we're still showing north of 7%, so we're way above normal, still have a long ways to go, and that's very important to keep in mind. While the market got pretty excited whenever that CPI data came across, we still have a long ways to go in front of us, so very, very important to keep that in mind. Also important to keep in mind, in a corollary kind of way, next meeting of the Federal Reserve Board is coming up here in early December, shortly after the Thanksgiving holiday. We expect at this point that there's going to be another increase from the Federal Reserve. We don't know how much at this point. I'm sure that will be a topic of conversation next week as we get closer to the time of that meeting and decision. So stay tuned for that. We'll certainly be watching the markets to see what's happening with that and hopefully get some kind of indication about how close they are, relatively speaking, to the end of this raising cycle. That really, from our vantage point here, is one of the most important data points for us to understand, because as we get to the end of that increase cycle or that raising cycle, the markets will begin to price in the quote new normal and be able to then move forward from where we sit, move forward in some more substantive ways. Short of that time, we're going to continue this washing machine sort of movement that we've seen here, although we have seen some more positive settling and movement here over the last couple of weeks, which really plays into the next point that I wanted to discuss. We have seen that. We've seen the markets respond relatively positively here over the last couple of weeks. We've seen some settling, if you will, and even some movements forward from the lows that we first experienced back in June, experienced them again here in October and early November, and then have had a little bit of a pushback in a positive direction, which is very encouraging to see. That's exactly what we would like to see. But I don't want to get the cart too far ahead of the proverbial horse, because we still anticipate we're 6, 9, 12 months out from a resettling in the market, because we just have to, as an economy, re-quantify what this new interest rate environment means. Yes, we have had a lot of movement in mortgage rates, car loan rates, lines of credit rates, prime rate. All of that kind of thing has happened very, very quickly, almost in real time, as we've seen the increase in rates. What we haven't been able to quantify, which is very understandable and very normal, is what actually does that mean as it percolates throughout our economy? We have a $27 trillion GDP, roughly speaking. It takes a while for interest rate increases to get out to the furthest edges of our economy and to see, most specifically, what consumer behavior looks like at that point. Because, as you recall from previous updates, consumer purchasing, consumer behavior, consumer consumption, without getting too wordy there, is between 2/3 and 3/4 of our overall economy. So what the consumer does has a significant impact on whether we're growing or contracting and where we see things going in the future, especially with regards to the bond markets and the equity markets. So still some road ahead of us here, still some understanding that we need to have about how these interest rates truly are going to affect our economy. And again, we're still 6, 9, 12 months out from really having a good handle on that. In the interim, you've heard me talk about, we're watching closely here about what the Christmas retail season looks like. Yes, it is an important data point. Yes, it is in terms of whether it's more or less than last year or previous years or our averages, but really what it is an indication of is consumer sentiment. And that's very, very important when we're looking at where we anticipate things going. Are folks still feeling comfortable enough to spend and to travel and all of those kinds of things? or are they becoming more closed, either because of lack of ability or lack of desire to be able to do that kind of thing? So we're watching these next several weeks very, very closely. Again, not because it's a binary kind of thought process, but because it is an important variable in our economic algorithm of understanding where we anticipate things will move from here. So those are the big items that are on our plate here. Never that we're looking at things in too short of a term, but obviously every single day, week, month has certain things associated with it, which either are continuances of certain trend lines or new variables altogether that we're watching closely. In addition to all of that, and this is a little bit of a sidebar, but it's something that we've mentioned here previously, and we're starting just to see the possibility of us moving in that direction. And that's with regards to what we anticipate here as an increase in the unemployment rate. We have been at an unnaturally low, and we say unnaturally not because it's our commentary to it, but because based upon historical averages, we have been at an unnaturally low unemployment rate now for several years. As a result of these interest rate hikes, a little bit of Econ 101, as a result of these interest rate hikes, we anticipate that that unemployment rate is going to continue to climb. I don't see a scenario where it's going to be unnaturally burdensome on the overall economy, and I'm not being insensitive to those who will become unemployed at all. That this is a very academic argument. I'm not seeing that this is going to become unnaturally burdensome on the economy, but we do see that that absolutely is going to happen from where we sit right now, because companies are going to have higher expenses with higher interest rates. They obviously have higher labor costs, and as demand is dampened as a result of these higher interest rates, obviously, we're not going to be producing as much if there is less demand. So we anticipate that the unemployment rate is going to continue to increase, and we just have seen a couple of the initial data points, specifically with regards to unemployment claims as of the time of this recording, which have ticked up a little bit higher. And again, singular data points, I don't get too carried away with it, but definitely something to keep in mind when we're looking at where things are going from an economic standpoint, because as counterintuitive as it may sound, if the Federal Reserve sees an increase in unemployment, they may be less likely to continue their path of increasing interest rates. So it all goes together in that economic algorithm and determining not only where we are, but where we anticipate things going. And so that's what's on our radar screen here. Well, I'm going to draw to a close because it is indeed your holiday time, and I don't want to take up too much of it, but I appreciate so much your patience and willingness to sit through this particular update. Always, 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 please feel free to reach out to us here, email, phone. You'd like to talk about what's happening economically or financially or with your particular portfolio right now, you know, we're always happy and willing to do that. If you'd like to talk about where your favorite football team is right now, especially during this time of Thanksgiving, it's kind of the zenith, short of the Super Bowl in terms of college and pro football experiences. You know I love doing that as well. It's pretty cold in many areas of the country, so especially in some areas, if you're up in western New York or northwestern Pennsylvania, eastern Ohio, you've had a lot of snow, a lot of winter already, so be careful out there, especially if you're traveling during this time. But again, always feel free to reach out to us if you'd like to chat. We always enjoy doing that, and happy Thanksgiving to all of you, and until the next time, I'll look forward to chatting with you soon.